our biggest risk really going into this kind of reflation and rotation trade always was spiking yields. And that's because the market, with yields so low, it doesn't really take a lot to really spook the market on some kind of bond market sell-off here. And what we saw in the last few days is yields moving very quickly as the PPI came in, and just concern about inflation moving to the forefront. And I think the market sentiment is going to be, we're getting inflation until you tell me otherwise. And so there's going to be strength in the cyclical sectors and strength in value. And I think you're going to see a softness in the tech sector just because those long duration assets are most affected when yields move higher. So this is a bit of a show me that there's not going to be inflation, because I think most market participants are expecting big reads as we cycle through the year and get those big base effects.
Well, yeah, and as we've showed our audience, I mean, pretty much every hard or soft commodity, fossil fuels, you name it, the price is probably up, at least in the last year, but a longer-term chart might show a different story. I want to go to stocks because small caps has been the story. We've been featuring and talking about small caps since June or July of last year on this program, which has been great for our viewers. But now, according to your data, 90% of the Russell 2000 are above their 200-day moving average. I'm no math whiz. 90% sounds like a lot. Is that overvalued?
Yeah, no, so it's a little bit counterintuitive to it. The number is actually the same for the S&P as well. Both are at about 91%. Of the constituents trading above the 200-day moving average. The reason that matters is because it shows the broad nature of the market rally. It's not top heavy. It's not being led only by one sector while other sectors fall away. It's very broad. And with this kind of breadth, you do not get market tops. You can get consolidation, and I think we'll see that here in the next few weeks, just as we absorb some of the gains that we've had. This is not a market top, and frankly, not a bubble, because bubblicious conditions do not happen when 91% of the constituents are making 200-day moving highs. So that's why it's important. I do think we'll pause here as the yields kind of settle in. I think they're going to move faster. But the issue is that right now, real yields are still very deeply negative, to the tune about -1%. And given that, there is no alternatives, and that's going to support markets.
And I'll tell you what's been supportive lately, and we don't pay a lot of attention to it, but we probably should. And I don't know what the longest timeline chart we have in our system for the Nikkei 225 in Japan is, but if you're not paying attention at home, Japan, despite terrible demographics, no growth, 4 or 5 recessions in the last 20 years or so, has just broken above 30,000 on the Nikkei since 1989. The year I graduated from high school, Alicia. Are you a believer? Are you a buyer? Are you big in Japan?
Look, Japan's amazing. It has been 29 years. And yeah, let's not talk about years, Brian. But look, Asia's breaking out everywhere. It's not just Japan. Actually, China broke out the first time since 2007. So equities everywhere in Asia are very, very strong. And in part, it's based on the cyclical recovery. So as the U.S. recovers, as other countries recover, manufacturing is stronger. And Asia really benefits from that, including the weaker dollar. So yes, we'd be buyers of Asia right here, including Japan. The charts tend to tell you where markets are going. And so the demographics are not great in Japan. However, they just had a blowout fourth quarter GDP. You may have seen it, up 12%. So the fundamentals are getting better. For the long term, probably there are structural issues. But we like Asia, we like Europe, and we like Europe for some of the reasons we're talking about, which is the rotation trade. Europe does not have as much tech. It has value and cyclicals, and those cyclicals are what's supporting markets right now.
Yeah, and thankfully COVID cases are crashing around the world. Let's hope that continues. Even in Europe, where their vaccine rollout has been terrible. I mean, we criticize ours here. They're at 1/3 our pace. You know, you look at sort of this vaccine boom that we're starting to see in certain places of America. You think Europe is just kind of lagging us by a few months, and once they start to get vaccinated and cases keep falling, hopefully they're going to kind of bust out and be where we were a couple months ago?
Look, it's hard to know. I'm hoping this is a delay and not a trajectory issue. So let's assume it's a delay by a few months. They have supply. They've been working on it. But look, fundamental to all of this is that somehow we all get to put COVID behind us one way or another. I think the data out of Israel actually has been very encouraging. You may have seen it, but Pfizer, in a real world scenario, each arm 600,000 people, still 94% efficacy, including variants in that country. So I think that really is the center of how we see markets. We have to get beyond this by, let's call it the summer, by the third quarter. Otherwise, the whole structure of what we're talking about does begin to fall away. And that's another big risk, besides the yield issue.
Shepard Smith here. Thanks for watching CNBC on YouTube.